Hello and welcome to the Estate Planning Toolbox. Thanks for taking some time out of your day to check out everything we have going on here. My name is John Connor and I am an attorney in the Trust and Estates Group of Graves, Doherty, Heron and Moody, a law firm located in downtown Austin, Texas. This podcast is a client-focused podcast covering various estate planning topics, including wills and trusts, powers of attorney, corporate entities such as LLCs and limited partnerships, probate administration, and everything in between. Thanks very much for stopping by. Hello everyone and welcome back to the Estate Planning Toolbox. Today we're going to be starting a series on estate planning with mineral interest and going to be doing something a little bit different today. We are joined by Nicholas Miller, who's a shareholder at Graves Doherty, specializing in real estate and oil and gas, and we are going to be discussing the finer points of negotiating an oil and gas lease. But before we jump into that, let's take a look at today's movie quote of the day, and today's movie quote of the day is, "It's just a bunch of hocus pocus." The only hint I'm willing to give you is that it's Halloween themed, since today is Halloween, so hopefully you know what that's from, but of course if you don't, stick around until the end of the podcast and I will tell you exactly what movie that comes from. So now moving into today's topic, discussing negotiating an oil and gas lease, the reason that I wanted to do this and the reason I wanted to start a series on estate planning with mineral interest is because mineral interest, especially for Texas-based clients, are very, very prevalent and can be very, very complicated. And as a part of that, one area we often come across is leased interest, royalty interest, and negotiating leases for those interests, which is why I wanted to bring in Nicholas. So Nicholas, welcome to the podcast. You have the perhaps dubious honor of being the first attorney interviewed on the Estate Planning Toolbox.
Well, thanks, John. I appreciate you asking me to join.
So let's go ahead and with our first question here. A mineral owner has been contacted by an oil and gas company, probably just got a letter offering them some amount of money to lease or something to that effect. So what is the first thing that a mineral owner should do when they get some kind of communication from an oil and gas company indicating the company wants to enter into a lease with the mineral owner?
Sure, and that's a good question. Most of my clientele, or a good number of my clientele, or at least new clients, come to me because they have received something in the mail or a call from a landman with an offer attached to it to lease mineral rights that the person may or may not even know that they owned. And just kind of as a general overview, today's topics are going to be very broad brush and general. Everybody's individual mineral interests are differently situated, and different things can make sense to different folks, just depending on how development is going on in the area, depending on the companies who are asking for leases, and depending on the size of interests, amongst a number of other factors. So this is a very broad scope review. If any individuals need their minerals looked at or have any questions of this sort, that may be more specific, then they're welcome to reach out to me. But the question was, you get a letter in the mail, you get a call from a landman, they say you own minerals out in wherever county, Texas. And the first question is, do you know that you even own that? Many times landmen will find your name in tax records or trace back to lineage or ancestors that you may or may not have known existed, or may not have known owned minerals that you might have inherited through generations that nobody has ever known about because they've remained dormant. Say something was reserved under a 1918 deed many generations ago by your great uncle Bill, and suddenly you are a partial owner in that property, and you didn't even know about it. That happens all the time. So the first question is, if you don't know what you own, figure out what you own. The landman should be able to provide most of that information. They're going off of title opinions that they have pulled. They have attorneys reviewing all the title in a given area, their area of scope, wherever they're looking to lease. And that's how they know who to contact and who are the proper authorities or signatories to sign a lease in a given area. So that's the first step. Know what you own. Know the size of your interest. Know where it's located. And who else may be co-owners with you. Now, just because, and I want to address that real quick, just because somebody is an undivided interest owner along with you, if your cousin also inherited some of great Uncle Bill's minerals, that doesn't mean that you have to agree with your cousin as to what to do with those. Everybody owns their undivided interest alone. And so you are free to negotiate, sell, or not do any of those things as you see fit. It's completely your decision. Just because somebody else does something doesn't mean you have to, and just because you do something doesn't mean they have to. That being said, it can oftentimes be to your advantage to get together with family members and kind of collectively negotiate your interest because you have more leverage. So you get that letter in the mail. First step, understand what you own and why they want to lease from you. The second step is to look at the terms and understand what they're asking for. So the offer will come with a couple different terms. First is the term of the lease. This is typically a 3-year term, and most often companies additionally ask for a 2-year option to extend the lease. This means at the end of the 3-year term, if they have not established production or have not commenced operations, that they can pay you another bonus figure, which we're going to talk about in a minute, to extend that lease for another 2 years. This means essentially they get a 5-year lease, but they do have to pay you more after the expiration of 3 years. So that's the first piece of information that you want to look for and see what that number is, or how many years they're asking for the primary and secondary, or primary term and option to extend. The second is the royalty rate. Right now, the going market for royalty rates in most of Texas is 25%, or a quarter royalty, as you'll hear it often termed. You will see leases being asked for in some areas for 20%, sometimes even less than that. Those are less common nowadays. Those were more common years ago. In fact, the most common royalty up until really the 70s was a 1/8, and everybody got a 1/8 lease. You might read old documentation, old wills or deeds that really refer to it as the usual 1/8, or even just the landowner's royalty, assuming that was 1/8. And that's how it was traditionally done until landowners got a little wiser and thought that they needed to be asking for a little bit bigger cut of the eventual production. So 25% is really the going rate now. The final term that you'll see in an offer letter is the amount of bonus. This can vary widely, just depending upon the area that you're in. Some areas in the Panhandle will lease for $50 an acre. Some areas in Reeves County will lease for $25,000 to $30,000 per acre. And when I say per acre, I don't necessarily mean per acre of surface acreage or the gross acreage, but the net mineral acreage, which means if your interest is derived from, let's say, a 100-acre tract, to make the math easy, and you sold that 100-acre tract, or whoever you inherited your rights sold that 100-acre tract, but reserved part of the mineral interest. Say they reserve 50%. That means that person, when they reserved that 50%, they saved 50 net mineral acres out of the 100 gross acres, or 50% of the undivided interest of the entire 100-acre tract. And whoever was the recipient of that tract, whomever they sold it to, also has 50 net mineral acres, which is the other side of that coin. Doesn't mean anybody's rights are stronger or less than the others, depending upon the reservation. It just means that you own an undivided 50% interest in this tract. So you have 50 net mineral acres under a gross 100 surface acres. The bonus is going to be keyed off of that number. Whatever that 50, if it's 50 net mineral acres, then 50 and $50 bonus, you're going to multiply the $50 times the 50 net mineral acres, and that'll be your total payment in exchange for a signature on the lease. One of the most common questions I get is, why isn't the bonus included in the lease form? I mean, I don't see where they've agreed to pay me $10,000 per acre on my Reeves County lease. Those terms are not in lease forms. That's a payment that is being paid to you in exchange for your signature alone, in exchange for really the primary term, for them to have the option to go out and explore your property for the term of the lease, whatever that is, the 3 years, the 3 + 2, 5 years, whatever the term is set forth in your offer. Usually, that bonus figure will be an amount that is roughly 75% to 50% of what the company will actually pay. So say they come to you and they offer you $2,000 per net mineral acre. That is definitely a negotiable amount. And you should try to get that as high up as you can, obviously, to benefit you and get more cash out of the deal. And the way to go about that is kind of understand the development that's going on in the area, talk to your neighbors, talk to other mineral owners you might know in the area, and see what they've been able to get. There's good resources online. Mineral Rights Forum is a great resource that I use sometimes. Kind of see what people are talking about in a given area of of Texas in terms of bonus payments and bonus amounts, what different companies may be offering. But also understand that even though they say that some people are getting $30,000 per net mineral acre in a given part of Reeves, that doesn't apply to the whole county. It is very, very situationally specific. So if you are one area of Reeves, you may get $500 an acre, and if you're the other, you might get $30,000 per acre. It really just depends on what is underlying, or what they think is underlying a property, and what production may be occurring nearby. Similarly, in the 3+2 scenario, the 3 years with a 2-year option to extend, will come with, they pay you for the initial 3 years with that first bonus amount, and then they'll have a second offer which will say, if we don't drill within those 3 years, then we get to extend your lease for 2 more years, and we'll offer you another lump sum of money. That can be the same as the initial bonus. It can be something different. I've seen it be less than the initial bonus. I've seen it be more than the initial bonus. But the most important point is that you want to get rid of that option if you can. The option is only there to benefit the operator. If it's a high number, it doesn't mean they have to pay you that at the end of 3 years if their lease has not started production during that time. It just means that they can. And let's say that the area does get hot and suddenly the market is really hot out there, but this operator hasn't done anything on you yet. They can still extend your lease for another 2 years under what may very well be less than market rates for that extension bonus that you might be able to get from somebody else who's trying to capitalize on the market at the time and get a good lease or get a good area under lease. And conversely, if the market falls and they have to pay a bunch for that lease to extend it, they're just not going to. So it just doesn't do anything for the landowner to have that option included, and it's always a good idea to try to negotiate out of that option. So just in quick review, the things that you'll see in an offer are the term, the royalty, and the bonus amount, and those are the first things to consider before you even look at the lease form. At that point, it may be wise to talk to an attorney and get an idea of what they think about it. The value in getting an attorney may depend upon the size of your mineral acreage. It may not make any sense. If you have a very small amount of mineral acreage, for example, 1-2 net mineral acres in a big tract, paying an attorney to look this over for you may not be worth your time. It may just be worth signing the lease, considering it found money, buy yourself a steak dinner, and move on. And hopefully you'll have a little bit of royalty down the road. But there's no liability imposed on you if you do that. I've advised many potential clients to do just that. Don't hire me. Go out there and sign this lease and consider it a little bit of found money, and just consider it a nice little windfall that might buy you lunch. So that's kind of what you do if you get that initial offer, and then we can go into kind of what we want to look at once those terms are decided and agreed upon in a minute.
What are some common pitfalls and or mistakes that you see mineral owners make when they're either in the middle of negotiations or just starting negotiations or doing anything in terms of negotiating with an oil and gas company regarding their mineral interests?
That's a good question, and I think I'll go back to kind of what we were talking about on the initial, you get that initial offer letter, and to assume, kind of the first one is just to assume that those are the terms. Like, this is what you're going to have to take. And if you don't sign this lease, that nobody's ever going to come back to you and ask for another lease. There are other companies who probably are interested in that acreage too that just haven't reached out yet. And certainly all those terms are negotiable. Every situation is different, and so that may not be the case. If you're on the fringe of something, that may not be true, but generally speaking, that is true. And once you come to those terms, then you negotiate the lease, and that's really where the big pitfalls can come in. There are a lot of areas in a lease form that they may send you first that would not be beneficial to you. They're most likely to attach to their offer letter what's called the Producer's 88 form. And they may have an addendum to that, a short addendum that gives you a few more bells and whistles over and above what's included in a Producer's 88, but it's mostly lip service what they're going to send you initially. They want you to sign that, and because that gives them control over your acreage in the maximum amount of control that they could have to kind of develop it how they see fit, which may be fine, but especially if you have a larger amount of net mineral acreage or a large tract. And you're really going to want to focus in on those and focus in on the pitfalls that you mentioned. The first one, and the one that I see most common, and we're getting a little bit into more technical aspects here, but is the retained acreage clause, or the maximum size, both that and tied to the maximum size of a pooled unit. And what that means is, so say you have that 100-acre tract that we were talking about, and they take a lease on that. They drill one vertical well, and I realize I'm dating myself a little bit here because vertical wells aren't commonly drilled anymore. It's all horizontals. But just for the sake of this explanation, I'm going to use this example. Drill one vertical well, and your lease says that they can only hold 40 acres per well, 40 acres per vertical well. That means at the end of the primary term, if that's all they've drilled within that 3-year term, then they have to release the balance of your acreage. So they give you back the 60 acres, and they can only hold that 40 acres. And they will hold that 40 acres for as long as that well produces. And I guess I should clarify what a term means in an oil and gas lease. When we use the word term, we're really talking about a primary term, but there's also a secondary term for a lease. The primary term is the amount of years that you see on the front end. It's that 3-year offer. It's that 2-year offer to extend. If that's an option. That's the primary term. The secondary term occurs after the primary term expires. And that, if they establish production during the primary term, then an oil and gas lease will perpetuate for as long as there is production coming from that well or a number of wells, depending upon the situation and the size of the acreage, for as long as they're producing and paying quantities. And once production is gone, then that will revert back to you, but it could last forever. My family has a lease, or has a ranch up in the Panhandle, and we have a well that's been producing on us since 1918. It's held that lease in effect since 1918, and that's not uncommon, especially with a lot of these old ranches in Texas. If that well continues to produce and it's showing no signs of stopping, then that lease will continue to perpetuate until it does. So that's something that you need to consider when you're negotiating these leases. It may be there forever. You just don't know. Every leasing opportunity that you have, you should consider it to potentially be your last leasing opportunity, because the goal of the oil and gas company is to go out there and drill and to hold that acreage with production, to make money off the production, but also to be able to report your acreage on reserves and to their shareholders or investors, to show them how much acreage they control and how much undeveloped reserves they may control, which can go on their bottom line. So all that being said, that's coming back to this retained acreage clause. One thing that these companies are loving to do right now is to add language in the retained acreage clause that says that they can hold as much acreage as the field rules, which are promulgated by the Railroad Commission, will allow them to do. Now, there are different field rules for different areas of Texas. You kind of need to understand what those field rules are that might be affecting the acreage that you own and the formation or the horizon that the company is looking to drill in your area. But typically, operators go to the Railroad Commission and they have a proposed set of rules, and the Railroad Commission will grant those rules unless there's some sort of protest and there need to be hearings. But ultimately, you have to assume that the field rules are all going to be very operator friendly because they wrote them, they put them together, they applied for them. The Railroad Commission granted them based upon their request. So for an example of what that might do to your acreage, if they're allowed to hold as much as the Railroad Commission allows, some of these fields, they can put in clauses where they can hold as much as 1,200 acres or something along those lines, or be able to create pooled units of 1,200 acres, which would dilute your interest on shorter laterals if they're drilling horizontals, or on production that's developed in a way that wouldn't benefit you, but is designed to hold a lot of acreage. This is their goal. They want to hold that acreage. That means they control it. That means they don't have to give it back, and they can go out and drill somebody else in order to earn their acreage. So this is the biggest thing I think nowadays it's important to look for. We have completely divorced our leases from the Railroad Commission rules. If they're unpredictable, it's hard to tell what they're going to do. A lot of them don't make sense, and I don't think they're based in reality, what's actually happening on the ground. And we use the same formula that we worked with the General Land Office to develop, which is 0.032 times the length of a lateral. And I'm kind of shifting to talking about horizontal laterals as opposed to my earlier example of a vertical well, which I was just really trying to explain how a retained acreage clause works. But with a horizontal lateral, it's usually better to build in a formula, because Horizontal laterals can be a variety of lengths. They can be 1,000 yards or 1,000 feet. They can be 5,000 feet. They can be 10,000 feet. I've heard of laterals up to 15,000 feet now. And the technology keeps getting better to keep making these longer. Now, if you tie that to a formula, our formula is designed for a 5,000 foot lateral, meaning a lateral that would traverse an entire section of land, be about a mile long. It would hold 160 acres, which is about a quarter of that section of land. Meaning a fully developed section would look like, what that would look like are four 5,000 foot laterals kind of lined up across a section of land, covering the full 640 acres. We think that's a reasonable approximation for the drainage pattern of these horizontal wells, because nobody really knows how much they drain. In fact, they probably drain less than that, but that seems to be a reasonable compromise. You'll get pushback on this provision. Oftentimes we have to double that figure, or that multiplier, to give them a little bit more acreage. And it just depends on how much leverage you have in your negotiation as to how much acreage they're able to retain with a full well, which not only benefits you in that what they don't drill comes back to you at the end of the primary term, but it also benefits you because you can get more than one well on your property, as opposed to just having that one well, having all your acreage held, and you can't do anything about it. You can have 2 wells drilled, which will double your royalties, or 3 wells, which will triple your royalties, kind of depending on the situation. We also tie the size of the pooled units that they can create, if you want to grant pooling authority, to that figure. Meaning, they can't create a pooled unit that's bigger than, say, 160 acres for a 5,000 foot lateral. That's really beneficial if you just own a small tract within that 160 acres or in the full 640. And so your acreage needs to be pooled with other acreage in order to create a unit of that size. If they are able to create a bigger unit, it just waters down or dilutes your interest. So it's certainly beneficial to restrict the amount of acreage that they can put into a pooled unit. But the same sort of push and pull applies to that as does the retained acreage clause in terms of what you might be able to get from a company. That's the main thing I look for. The other thing that's very important is to get a cost-free royalty. The case law on royalty expenses I'm not going to dive into because it's completely complex and we could talk 2 hours about just that. But suffice it to say, the case law is not friendly to royalty or mineral owners and allows operators, unless there's very specific language in your lease that says otherwise, to deduct their expenses for marketing the production, the oil or the gas, or transporting the oil or gas, or compressing it, or respining it, or processing it. Whatever those post-production costs might be, they'll charge those against you, against your royalty for your percentage share of those costs. Really what's market now is a cost-free royalty, meaning you don't have to pay a share of those costs. They pay you a portion of the gross proceeds. They don't get to net out whatever they've spent on marketing those minerals or transporting those minerals or processing those minerals. They pay you a blank percentage of only their gross proceeds. So that's another area that I would focus on. And there are many others, of course, as you negotiate an oil and gas lease, that may become important. But really those 2 areas, I think, are, at least now, can be some of the most important to focus on.
Well, that is going to just about do it for today. But Nicholas, thank you very much for stopping by. You've certainly given our listeners a ton of great information that they can use if and when they ever find themselves negotiating an oil and gas lease. And speaking of oil and gas leases and land and mineral owners, I want to mention one other thing here before we go. Next Friday, November 9th, 2018, Graves Doherty, Huron, and Moody will be hosting its land and mineral owner seminar. That information is on the screen in front of you right now. It is hosted at the Intercontinental Hotel, the Stephen F. Austin Hotel here in Austin, Texas. That is at 7th and Congress. So if you are interested in coming, please register quickly. There is limited space available, but we will certainly hope to see everyone there next week. Now, before we go, here is today's answer to the movie quote of the day, and it is from the movie Hocus Pocus.
It's just a bunch of hocus pocus.
Like I said, a pretty easy quote, pretty obvious since the title of the movie is actually in the quote itself. So I certainly hope that you knew what movie that it was from. And that's going to just about do it for today. So thank you very much for stopping by, and be sure to check in again next week as we continue our series on estate planning with oil and gas and mineral interests.